Good morning, folks. I hope you had a wonderful Deepavali festival and wishes for your prosperity, good health and wealth from us as always. Okay. And we have changed our weekly wrap format. Let's see, we always like to experiment. And I think all of you would have got rather bored of seeing only my face in the frame. So I'm going to have my team members participating in the weekly wrap from now on. And today we have Hiloni, who's our research analyst.
Hi.
And, she's going to be joining the conversation with us today. So Hiloni, let's kick off with the big event that happened over the weekend.
Yes.
We had precious metals and crypto crashing like 9 pence.
Yes.
Right? So what do you think happened?
So there was a huge correction in gold, crypto and silver, all three risk assets. There was a massive sell-off. This is the biggest sell-off that has happened in the decade. So gold has corrected around 6% and silver has fallen much more at 8%. Silver's correction began much earlier than gold. Silver started correcting since 16th of October, whereas gold and Bitcoin have corrected from 20th October. An interesting thing to be noted here is that Bitcoin has corrected much more than gold. So gold has fallen around 6%, whereas Bitcoin has fallen around 12%. So this goes back to our discussion on can Bitcoin help or support in terms of crisis, in a situation of crisis, which we were discussing last week.
So one thing that we have observed here again is that Bitcoin fell much more than gold and silver also fell double that of gold. So it's like Bitcoin and silver in magnitude fell to the similar extent, so about 12 and 14%, and gold fell half these two assets.
Sure.
But the point remains that all these three experienced a sharp correction. And the reasons that were given were many, right? They said with geopolitical tensions coming off, possible trade deals happening, and hence the need to reduce your holdings in precious metals, because these are broadly hedges against uncertainty, right? But what actually there can be many reasons given for something to go up and something to come down, but fundamentally I think we should not miss the fact that whenever an asset price goes up sharply, it has to let off steam, it has to collect, and the justification for that movement can be anything. It just happens that we've seen crypto shooting up sharply, we've seen gold and silver running up very, very sharply, and if you see these graphs, they're like parabolic. It's an exponential rise in the prices, so it has to cool off. It had to happen before Diwali. Okay. So one thing that can be observed, right? You were looking at the correlation.
Yes.
Of gold and crypto and the S&P 500, right? What was it indicating?
So in terms of gold and crypto, they haven't been much of a correlation if you see long-term periods, say 5 years or 10 years. But in the recent 1 year, the correlation between crypto and gold has been at 0.85, which is a very high correlation, which also explains the synchronized sell-off of both the asset classes.
So in the long term, they do seem uncorrelated, gold and crypto, but in the short run, they are highly correlated.
Correct.
Is it not? So, and I think one needs to step back and see what caused this higher correlation. And what seems to have caused this higher correlation is the higher liquidity. Okay, so since COVID, we've been seeing a much higher liquidity in the Western markets and in global markets in general, and this we can see as measured by the growth in M2 supply. Okay, and when you have a higher liquidity sloshing around, the risk appetite also goes up, and with risk appetite, the asset prices of anything and everything goes up. So if you have a risk off mode, all these asset prices which have gone up come down. The market ceases to discriminate between what is a hedge against uncertainty and others. So all of them have become risk assets. Gold has become a risk asset, crypto has become a risk asset, silver has become a risk asset, equity has become a risk asset. Okay, they just took their turns going up, and when they had to fall, all of them fell. So crypto was supposed to be a hedge against fiat currency, but what we have been seeing is at any time when markets were worried about uncertainty and prices fell, crypto fell much more than everything else. So it's extremely volatile. It does not seem to be a hedge against uncertainty given the behavior that it has been experiencing. Gold, supposed to be a hedge against uncertainty, it should be a store of value, but while in the medium and long term it would still fulfill that purpose, in the short term it has got caught up in speculative rise. Okay, it has corrected as much. So one has to be very watchful whenever you see a sharp rise in the prices of any asset. There could be some steam let off. Just like what many analysts are saying about artificial intelligence.
Correct.
Okay, that also has experienced a sharp move up. We don't know when the steam will be let off there, but I guess it will happen. It's the law of nature.
To add to your point in terms of risky asset, since 2020, we have also seen a higher correlation between Bitcoin and S&P 500, which was not present before.
All right. So all these higher correlations happen because of more
Liquidity, yeah.
and we are not seeing any signs of that come down. Of course, the Fed has said yes, and the Fed has said it's come to the end of its tightening cycle. So it's not going to be drawing down its balance sheet anymore. So yes, we are going to have this liquidity, and if governments have their way with fiscal imprudence in the West, especially not happening in the East, we could see more of liquidity. We don't know when and how this will end. Okay, and on the subject of gold, there's also an interesting article here in the Mint which talks about the gold oil ratio. So we've spoken about the gold silver ratio in the past, and there can be all kinds of ratios. You can have gold oil ratio, you can have gold silver ratio, you have the gold S&P 500 ratio. You can measure everything in terms of everything else, but is it relevant? It's just is the question. Okay, so now we have the gold oil ratio which is pointed out to be very high. So if a ratio is very high, what happens to correct it? Either the denominator should go up in value or the numerator should come down in value. So are we saying that the price of oil should shoot up to get the ratio back to normalcy, back to mean levels? But the demand for oil is not so great. Okay, we've actually seen the global demand for oil coming down so much, especially in the developed countries, in the OECD countries, it is negative. Whereas in the developing countries, at least there's some growth in oil consumption. And also there's a replacement for oil in terms of EVs, in terms of renewable energy, solar energy, wind energy coming in many parts of the world and fulfilling some of this need. So the kind of primacy that oil had as a fulfiller of energy, say 3-4 decades back, is not the situation today. Plus the lower demand because of lower global growth itself. One is a replacement. Second, lower demand, lower growth. Both of it which are causing oil prices to remain soft. Of course, now we have the sudden spike of 5% in oil because of the US sanctions on Russian oil companies. So India and China will no longer be able to buy as much oil or any oil from Russia given the sanctions. And we have to source it from the non-Russian oil markets, which has caused the oil prices to jump up so much. And this could have its own impact. For a oil importing country like us, if the oil bill goes up, it could feed into our inflation. But here, let us remember, it's not just India that's going to suffer from inflation. Globally, if oil prices go up, everybody suffers from that price inflation.
Correct.
Not just India. This time we are not alone. Okay. So America, Europe, Middle East, China, India, all of us could experience higher inflation because oil is a large part of any inflation index. Okay. And we could also have an impact on currency. If our import bill goes up, we're just hoping that this is one more of Trump's tantrums and going by his reputation of the taco trade, he will take it back later and oil prices could normalize. So we are in such a volatile environment. One comment
And
by somebody in the position of power can change global dynamics. This is a major change in the way the global markets are running, and we have to live with it, I guess. We cannot wish away volatility anymore till the powers that be themselves change. But I believe that many of these things are broken already. And this kind of multipolar world is here to stay. Maybe it's for the good. Let's hope.
so then oil to currency ratio would have been much more better to interpret than a gold to oil.
Yes, at least it will have some impact on, we will be able to figure out where our current account deficits are heading, where our trade deficits are heading. It could be more useful.
Yeah.
Okay, so let's try that out.
Yes.
And then, of course, we have been looking at some data on mid-cap funds, isn't it?
Yes.
Why don't you tell us about it?
Yes. So we have been looking at data on mid-cap funds in terms of outperformance to the index. The index which we are looking at is Nifty 150 mid-cap index. What we have been seeing is there are a lot less funds which outperform the index in a down market than in the up market. So in the down market, which is the last 1 year, where the index has been around minus 0.2%, only one fund has been able to outperform the index.
That's all. Just
Yes,
one,
just
out of
one.
25 or so.
25, yeah. And these are regular funds, so they account for expense ratios as well. And in the 3-year period, which is where we have seen the rally in the index, where we have seen the index go up 24%, out of the 25 funds, only 14 odd funds have outperformed the index, which makes up around 56% of the entire universe that we have in India.
So here the universe is like only those funds which have at least a 3-year history.
Yes.
Okay, of in the mid cap space, of course. So it is rather noteworthy or disconcerting in a way that only half the number of funds have been able to outperform the index in the mid cap space.
Yeah, the active fund.
Yeah, if you're looking at 3-year CAGR kind of thing. But also what was very revealing in the data that you had is that the funds that fell more than the index, they fell a lot.
Yes.
While the 3-year CAGR might have shown an outperformance of the index, it also exposed the investor to very heavy volatility. So on the downside, they fell much more than the index.
Yeah, so there was one fund in the downside in the last 1 year, which is down around 8%. So that is like a 9% fall against the benchmark. However, in the 3-year period, the same fund has a 7% outperformance.
So 7% outperformance on a 3-year basis.
Yes.
But when it fell, the index fell 0.2% and this fell
8%.
almost 8%. So that is the much higher volatility. So I think when an investor is getting into these funds, they have to be far more conscious of the style of the fund manager, and in seeking that alpha, what is he giving up? He's giving up a lot of downside protection. And so all this depends on the timing. If you were there for the long term, if you had invested 4 years back, you would not feel the pain. But looking at the performance and running after alpha, if you invested a year or two ago, you would be feeling the pain.
Yeah.
Okay, and many investors may not be conscious of this behavior of funds. They have to look at it, or they should take the help of an advisor who has a reasonable research ability to look at this and find out what is suitable for the investor. So not every fund is suitable for every investor. So you have to go into investor risk tolerance, risk appetite, and then design the portfolio, right?
Yes.
This is what you're good at doing.
Yes. Thank you, sir.
Okay. So I think that's all for you folks. I hope you like this format. Do let us know if you like this format. All the best. Have a great weekend.